Elevator Pitch with Jonathan and Mitch is made possible in part by National Real Estate Advisors.
Hi, Rob Lester, SVP of RMR Group and Chief Investment Officer for RMR Residential. I'm here wearing a suit for the first time in a year in New York, and I'm excited about Elevator Pitch with Jonathan and Mitch.
Welcome to Elevator Pitch with Jonathan and Mitch. I'm Jonathan Shine.
And I'm Mitch Berkey.
And Mitch, you know who we have here today?
Unbelievably, we have the great Rob Lester, CIO, RMR Residential.
Welcome, Rob. Thank you for joining us today.
Thanks, guys. Excited to be here with you guys.
So let's start off a little bit about you. Okay, you're returning to New York this week.
Triumphantly.
Triumphantly, we're returning to New York as you kind of made your bones here, as they say.
Yeah, it's very interesting to be back. Moved away during COVID and things were different and for a couple of years.
Well, how long were you here?
I was here for 18 years. I came with I was already advanced a little bit in my career. I had made some stops, I had lived overseas, but had always wanted to come to New York.
So we will unpack your journey because there's a lot to unpack from Malibu to Germany to New York and back.
Yeah.
But let's talk a bit about RMR, and specifically RMR Residential. Share with us.
So RMR Residential we're a residential investor operator. We own, operate, manage about 20,000 units. We were acquired by the RMR Group at the end of 2023. We're specialists in the Sun Belt. We've moved a little beyond. I like to say that it's sunny in Denver now, so we call that the Sun Belt.
Who was acquired? Who did RMR acquire?
So we were the Carroll organization, which was founded in 2002, 2003, so we're about a 22-year-old organization. One of the things that Carroll did early on is acquired property management companies. So always at the core of our DNA is what I like to call the post-acquisition execution. Finding the right asset, knowing the right location is all very important.
But when you buy, you have a business plan in mind, and it has to be executed.
And that's where the money's made. Now, from 2015 or 2013 to 2018, we did a lot of other people, we had a business plan, but we didn't need to do it because prices went up and then, we exited. But yeah, and we are a very team organization. We have what I think is one of the best asset management teams in the business. So when our acquisitions team and myself and the organization find an investment opportunity, we bring in all parts of the business. That's property management, that's insurance, our in-house marketing and branding, but also asset management, construction, whatnot.
So let's go back to the acquisition.
Yep.
So RMR Group acquired Carroll. It was about 20,000 units is what you said?
We were probably a few more at the time. We've sold a couple things. But
Okay,
yeah.
so was this a gap in RMR Group's
Yeah.
portfolio? What was the theory or the mission behind this acquisition?
Sure. So the RMR Group is a 40+ billion odd assets under management, real estate focused, real estate only asset manager. There are two holes missing in what the future of RMR wanted to be, and that's residential. They have a senior living business, but it's different. And so the big hole was residential and private capital. They had made some forays into private capital. There's a couple strong relationships and a few investors here and there, but did not have any tenterhooks into private capital and certainly not in residential real estate. So that was the strategic fit.
This episode of Elevator Pitch with Jonathan and Mitch is sponsored in part by National Real Estate Advisors. Transforming real estate for over 2 decades, National Real Estate Advisors builds long-term value through responsible investing, quality development, and strategic foresight.
So our vision kind of has multi-prongs, and just on the capital side, we'll continue to do joint ventures. So the second part of what we're doing is what we call our enhanced growth vehicle. What we're doing is we're taking some of the assets that we've acquired on balance sheet recently, and we're also putting in some of the GP-LP properties investments that we've made. We're packaging it, and we're going out to market to find some investors to join that. That vehicle is intended to, we've got about $100 million of equity in that vehicle right now, so $400 million of total value. We're going to try to get some more to expand this vehicle, a couple $100 million more. That is a stepping stone to then what we'd like to do is also raise a discretionary commingled.
That the EGV is not a fund structure.
It'll be a club joint venture structure where there will be some shared governance, but we do want to have some discretionary control because we're trying to take the next step as an operator, as a company, and also RMR has operated for 30 years as a discretionary operator of publicly traded REITs, so it's definitely in our comfort zone. That said, we're always gonna do joint ventures, even when we do a fund. And our vision for a fund is, $300, $400, $500 million, of moderate size, also, with our moderate goals in the interim. Not everything's gonna fit there. The fund needs diversification. It needs a specific strategy around how many assets are gonna be in one location or what type of assets or different kinds of business plans. So there'll be things that we'll do outside of those joint ventures, of the EGV, and they'll still be joint ventures. And we specialize in value add, where there's real work to be done. So there's also, and that EGV will have real sort of value add, high teens return investments. All the things we've acquired so far for this will be our high teens and above. But we see a lot of really interesting core plus. We're not the only ones. That's the most targeted investment opportunity right now. And sometimes we'll find a value add opportunistic deal in a core plus market. And it's also blurred. In the last 10 years, core plus is just, it's a return. If I get a 14, if I underwrite to a 13 or 14, it's core plus. A lot of core plus deals in the late 2010s, you go in a core plus strategy and you get a 30 because rents went up, and they spiked so high. We are very excited about Denver. We think long-term Arizona. It's challenged right now, but we like it long-term.
You like it for existing assets or for development or both?
Existing assets. I think it needs to stop developing for a while, except Scottsdale, that you can develop. And the East Valley, Chandler and Scottsdale, that's the place to be now. It may change in a few years, but we have a property there that we like. It's a great asset. We bought it at, sort of peakish. So we'll, manage that one till it's time to move on. We love Nashville, very hard. All the cranes that were in New York City went to Nashville. Yeah. So, but RMR, we have a very large mixed-use development project that has been kicked off in a few years, but that's going to be hotel, office, resi, everything in a fantastic location near the stadium. Our newest market is suburban Boston. Oh. And it's
Is that due to RMR?
Absolutely, 100%. And we're not a downtown high-rise Boston group for residential. But there's great suburbs, and it's been one of the best performing markets.
Are you university oriented in that respect, or not necessarily?
No, we are demographic, jobs, and density oriented.
This episode of Elevator Pitch with Jonathan and Mitch is sponsored in part by National Real Estate Advisors. Transforming real estate for over 2 decades, National Real Estate Advisors builds long-term value through responsible investing, quality development, and strategic foresight.
So at this point, with being in 50 states and having the RMR history with Carol joining, from a deal sourcing standpoint, are deals just coming to you regularly, or are you out there beating the bushes, or is it a combination?
Yeah, so residential is a deep, sophisticated, and highly marketed asset class. So the brokerage community knows us well. They know, and they know our activity. We have regular calls, regular meetings with them. We get some early looks. We get some, like a lot of people, they tell us we're the prettiest, and like they're telling.
You get the book before anybody
That's
else
right,
gets
like
the book,
everybody
of course.
Recently, we did do an off-market deal, and so they're few and far between, but they can happen. So we came in second in a property in Florida that we really wanted. It was fantastic. It was fairly new, 2015. It was big. It hadn't been managed particularly well, and we just saw lots of opportunity. We came in second. From a brokered process, there weren't too many that made it to the end because it was such a big asset. It was 100, mid-hundreds, and the sweet spot is sub 100. Anyway, because of what we did on that deal, the broker brought us a deal that one of their other clients said they wanted to do quietly, and because we were second, did we want it? And so this is a fantastic asset in Orlando that we're about to close on. The biggest challenge right now is capital. We're coming out of a period of time where capital is extremely scarce, which came after a time when capital was everywhere. And it's hard to do our business, which is primarily dependent upon joint venture partners coming along with us. So that's been the biggest challenge, is being in front of the capital, explaining to them why our investments are timely, valuable, and we're going to hit the returns and we're going to hit the rent growth. So
Is it a challenge because you have to distinguish yourself from others?
Always, but right now there's very little belief in rent growth. And so our value add business plans still require, we're going to spend $15,000, or used to be 12, it's 15, it's about to be 17. We spend that to renovate a unit. We've got to be able to raise the rents a proportionate amount. If we can't, then you can't do the renovations, and so your investment thesis falls apart, and it might still be a great asset, and you might still get a small return. There's also, which the allocators, whether they be pension funds or private equity or just asset management, they have other things to look at, right? Data centers over here, that's pretty, and we're getting, in development data centers, we're getting a lot. So compare it to, a rental property, it doesn't sound sexy, which goes a little bit to my second challenge, which is always. We believe in risk-adjusted returns. So I'd put risk-adjusted multi up against probably anything else. Now there's times when maybe there's no risk in data centers, I don't know. But for our 15, 16, 17, 20, 21 return, the risk isn't, if you do it properly, and we've made some mistakes in the past, and I can get to that, but the risk isn't that you lose your money, it's that you get a 12 instead of a 17, or a 9 instead of a 17, if you do it right. So one of the things that I spend time on is how do we mitigate risk? First off, the 3 magic words in investing, which I have the printer copy from college that I carry with me, is margin of safety. Those are the 3 magic words. Seth Klarman wrote a book, Baupost.
Did you say margin safety?
Margin of safety.
Margin of safety, okay.
Seth Klarman wrote this book years ago, and it's kind of a Bible, but you can't really, I don't even think you buy it anymore, so I have this paper copy. But anyway, margin of safety is one of the most important things when we're looking at it. So that's the discount replacement cost. We're always looking at discounts to replacement costs and how low we can go. It's been a pretty fruitful period for that.
Jonathan, what do you say we pivot back to Rob's journey?
Yes,
the Rob
I think
Lester
that
story.
We need to know Rob's story.
California boy, New York, Germany, back to California. Walk us through it.
So I grew up in Rialto, California. It's the Inland Empire now, and it was way before anyone decided to put a logistics center there. This was, my friend's home probably will not like this, but it's the hood. And I grew up, in a sort of regular place, middle to the bottom of middle class. Didn't expect anything. One of my friends, his dad had a Corvette, and we thought that's the richest guy that has ever lived. The reason I say that is because it's the foundation of the core of who I am. Is I never expected anything. I was never given anything, and I had to hustle for everything that I ever got. My entire journey is about discovering what I wanted to do. My dad was an engineer and my mom was a school administrator. They were great parents, but they didn't direct us in any way.
There was no real estate in your world at this
No,
point.
and they also didn't have any friends
I would just
with.
say resilience has certainly prepared you for this industry.
Yeah, and they didn't have any friends that gave me jobs. I was like, get out on your own. So it helped me. All these places I've been, I've come in thinking, I don't belong here. Blackstone, right? I don't know, okay, these are smart people. And Steve Schwarzman once in a while would joke that he probably couldn't even get a job there now because the talent there is so great. But I wasn't afraid, and I always felt like I was bright enough and gritty enough to do it. And so I did a lot of things. I, spent a lot of time in investment banking. I took different classes in school. I raised capital. I did principal investing. I worked for some great people and I worked for some terrible people.
That's where you learn the most.
Yeah.
It is, and it's where you learn that there's not really a safety net, right? Like if angry person doesn't like you, you still gotta, we like our careers, we like what we do. You still gotta go to work, and you gotta take it.
This episode of Elevator Pitch with Jonathan and Mitch is sponsored in part by National Real Estate Advisors. Transforming real estate for over 2 decades, National Real Estate Advisors builds long-term value through responsible investing, quality development, and strategic foresight.
So I worked at Alex Brown, which was, beginning of an investment banking career. And Alex Brown, after I was there, was bought by Deutsche Bank. And so I went to a lot of mergers as a young person. But so working at Deutsche Bank, I actually got to go do a number of transactions in Germany, which was really exciting. And I learned also that my German that works in Frankfurt go a couple hours away, and I don't know what you're saying. It's very different. But that was special. And I would say I, should have stayed, would have stayed, it would have been great. But, I still like, where we are and our family and friends here. So I came back. When I was looking for a job and I moved to New York, and this opportunity came at a place called Blackstone. And I didn't really know much about it. I mean, because look, real estate was small there, and I was also in the sort of, banking and capital part of it, not on the principal side there yet. So I'd kind of heard of Blackstone on the PE side, because that's where they're big, but real estate was pretty small. And so I sort of snuck my way in, but I didn't really, it wasn't
that's
Blackstone.
That's a little bit of humility. You didn't sneak your way in. They do have security.
Yeah, exactly. But
I think they might have liked your grit and hustle.
But
How's
it was,
that?
and they did, and it was, I want to say 200 or 300 people. The things I've learned in my career, some people would get tired of me talking about Blackstone, but I learned a lot of things. I was, from one of my spots, I was in every investment committee, and so I got to see a lot of how you think. And I'm not sure how they do it anymore, but there used to be a core, Steve and a few other people. And you do all the investment committees on Monday, and as it got bigger, there Asia pops in or whatever. But you could see what was going on, and that was the value of the Blackstone platform. And investors love to get information like that. They're not seeing it, and I think that's one thing Blackstone does very well, is they provide scarce intelligence that you can't get anywhere. So you visit them in their place and say, this is what we're seeing. We'll come back when there's investments to do. And that's a lesson that I've never forgotten, is you don't only want to call investors when you want want an investment or you've got something for them. You've got to, the relationships are you got to foster them, and they're deeper, and you've got to spend time. And again, that's why I go back to, we value all these relationships that are the Carroll relationships and all the ones we make that are new, because at the end of the day, everything we do depends on relationships. We can't do it all ourselves. So
That is an amazing place to really kind of land, is we're people, and it's a people business.
yeah.
And for our viewers, and they're listening to your amazing story, and California kid, now CIO, and the roadmap to get there. But for those thinking about getting into the industry, or they're already in the industry, but they're trying to carve a path similar to yours, can you distill some of those elements into a game plan or some advice?
Yeah, and okay, some of the advice is things that I did and things that I didn't do and should have. First thing I would always say is it's do what you like and find out what you like. And so my path was, healthcare, banking, to raising capital, to principal, to all these things, Europe, to New York, to other places. Find out what you like and sort of go for it. I used to have a lot of friends that, in advertising, and they're getting beaten up, and they're like, oh, there's investment bankers and Blackstone people that make so much money. And I'm like, do what you love, it will come. Don't worry about that. The second thing is, and this sometimes is hard, but don't be afraid. I love my journey and wouldn't have it any other way.
Well, Rob, thank you very much. And Mitch?
I think we're ready for the lightning round.
We are ready.
Wait, can I start?
You want to start?
Yes.
You want to ask us?
Yes, I got one.
He's turning the tables on us.
Wow.
All right, Mitch. This one might be a little corny, but Michelada or Michelob?
I'm getting a little older. Weight issues, Michelob Light.
All right. Jonathan,
Yes, sir.
sunshine or moonshine?
Moonshine.
Is it our turn?
Yes, it is. That's
Okay.
right.
Okay, here's the first one. I know you're a Mexican food guy. Hot sauce. Are we talking about mild, hot, or scorching?
I go scorching, and I like them all. Mild doesn't do anything for me, so I go scorching.
Okay.
Scorching. Nice.
Absolutely.
You were an athlete.
Yep.
Wilson or Spalding?
Spalding. Yeah. I can see it on the orange ball. Yeah.
So you're not a Castaway Wilson volleyball fan?
No, and I struggled through that movie, frankly.
Okay, I get it. All right, here's our last one, and we ask this of every guest.
Yes.
Is it better to be lucky or to be good?
I mean, both. I'd rather be good.
Okay.
I'd rather be good, but both are
And
better.
I think if you're good, you make your own luck. How's that?
Well, and part of to me is I've never chased an end goal. I've never chased, not to be I've never chased money, or I've never chased that. I've tried to do the best work I can. I'm very interested in the complicated things and doing the best. So good is more important to me. I do think with good comes accolades or whatever that you want, but I'd rather be good.
There we have it.
Rob Lester, Chief Investment Officer, RMR Residential. Thank you for joining us on Elevator Pitch with Jonathan and Mitch.
Thank you, guys. It's been great.
This episode of Elevator Pitch with Jonathan and Mitch was made possible in part by National Real Estate Advisors.